Welcome back, everybody. As promised, I have my good friend Allison DiSarro with Enterprise Bank. Allison, thank you so much for being with us today.
Thanks for having me. It's nice to join you.
Well, I had to get our resident NARPM banker on the podcast. I think people would have been amiss if I did not get you on, especially what happened with the SVB banking or the Silicon Valley banking incident. So can you tell us from a banker's perspective at a high level, what actually happened with SVB Bank, and then give us an overview, and then give us your opinion on what, if they didn't get bailed out, what do you think the cascading effect would have been?
Okay, so I'll first say I think this is really important because the majority of what we and probably every other banker out there too, but what we at Enterprise have been dealing with our customers in any industry, personal or corporate, for the last now 2 or 3 weeks, is really just the fear, right? And so I think it's important that everybody understands, like you said, what happened, because you don't know what happened and you can't really understand whether your bank is doing it right or not, or at least just have faith in your bank to whatever degree you can as a consumer. So in a nutshell, what happened with SVB was, I think, a few triggering factors. One, you've all heard this, but the majority of their clientele was VC-backed tech startup companies. And then when it came to the personal side, it was mostly high net worth individuals linked back to those companies. So that's important to know, first of all, because, generally a bank really shouldn't have that much of a concentration in not only one client, but really one industry. A little bit of context here. So like I came up, as a banker, and once we started getting really successful, I remember my CEO at the time always said, like, no more than 10%, which means that no client can have more than 10% of your deposit portfolio at the bank. And the reason being is, as I'm sure many of you can understand with your own clients, if one client leaves and they have more than 10%, that's a giant loss on the bank, right, that you have to make up for. So what I also think is that you shouldn't have more than 10%, well, probably more than 10%, probably, but you still need to have a concentration limit on industry as a whole, not just the client. They had almost everything on this one industry, so they were really relying on them. That's important to know to then understand what happened next. So in general, banks, I'll kind of break it down. Let's say, banks obviously do loans and deposits. Deposits are essentially the liability on the bank. You place your deposits with the bank. It's a liability because when you want to take your deposits out, the bank has to give you that money back. But the banking system doesn't just sit on cash like that. So when you get the cash, so to speak, the deposits, you lend them out. And if you can't lend them out, meaning you can't make safe, sound loans, or you just don't have the driving loan industry to back up those loans, then you have to invest that cash. Many banks diversify and do many of those things, right? So you lend, you invest in many different types of investments, but a lot of banks do invest, most banks actually do invest in what's called treasury bonds and mortgage-backed securities. That is not uncommon. That is actually very fairly common. The problem is that when Silicon Valley Bank invested the majority of that money in the treasury bonds, they were investing it in long-term treasury bonds. Now, before Fed started increasing rates back in, correct me if I'm wrong, I think it was around February or March at this point. It's been a crazy year, but before they started increasing those rates, would that have been, recommended to put the majority of their investments in those long-term bonds? No, but it probably wasn't as risky then because no one expected the rates to continue to go up. They were as low as they could get for several years. So, and that no one really saw them continuing to go up. Then, of course, Fed started hiking rates. So as those rates start to go up, the value of those bonds get lower, right? So if they had, invested in 1 year or 2 year treasury bonds, they would have been in a much different boat. But what happened is there was, back to this industry, right, of venture capital companies and tech companies, Fed started raising rates. It was more, it was easier for them to, instead of secure a loan, to then go and just access their cash. So they were accessing their cash, which created a slow runoff of deposits. not what anyone would consider a run, just a slow decline in deposits. So the bank has to start paying that back. So now they have to start accessing these loans, but they're taking a realized loss on these, not their loans, they're treasury-backed securities, treasury bonds and mortgage-backed securities. And so they had to continue to take a loss. They took, I wish I could remember the number off the top of my head, but I'm blanking. It was a gigantic loss on these funds in order to pay back their depositors. So they essentially went to go ask to raise more money. Unfortunately, because you're just one industry that they're banking essentially, and this is really my layman's terms way to explain it. Word got out, people lost their faith, and because it's one industry, you're essentially listening to a couple people who run that industry as a whole in Silicon Valley. They take your money out. So in, I think, 1 to 2 days, there were billions of dollars being run out of Silicon Valley Bank. And in order for them to pay them back, they had to access all the capital that they could, and they couldn't liquidate fast enough, and they also couldn't even liquidate fully. So they were, from that moment on, in a deficit. And then that's when the Fed came in and broke them down, took them out, because there was no money to pay back the depositors. So, and that's really in like a layman's term, nutshell way to explain it. But I think it, like I said, it's really these triggering factors. One industry who is highly influenced by just a few people, I mean, in the grand scheme of things, in Silicon Valley, and a bank that wasn't making sound loans. If you think about the majority of their loans, they were also lending to these VC-backed and startup companies. VC-backed is one thing, but startup companies, they're, what I call, I hope you don't mind my candor, just airball loans. So now they also didn't have the pledgeable loans to go and liquidate either. So now they're in, again, it's kind of like it's the worst of all the worlds. It's just it was a bad storm.
Now, when I deposit money into my bank, and my understanding is the bank can actually invest like 10 times the amount of that $1 that I put in. Is that true? Like they can do other things like with that money. Like it's not just a 1-for-1. They can say, oh, we're going to go ahead and invest $9 or $10 for every $1 that they have in the account. Does that sound right?
Yeah, unfortunately, I can't speak to the number, but yes, they can. They have an allowance to go out and loan against.
Got it. Okay. All right. So if Silicon Valley Bank wasn't bailed out, what do you think that this would have dominoed into other banks and other industries, or do you think it would have been kind of firewalled off and just really hurt the tech industry? What are your thoughts?
Well, I think what you mean when you say bailout is backstop, right? The Feds came in and backstopped the deposits so that everyone got their money, whether they were insured or not, essentially, right? Because they weren't really bailed out. They did go under. So if they weren't, I mean, honestly, I hate to even think about that. I think it would have been a catastrophe. It would have been an absolute catastrophe across the banking system, across the economy as well. The amount of companies that were, these companies had billions of dollars. Some of these companies had billions of dollars in one bank. In order to put into their companies, and this is Silicon Valley as well, right? Like this is major tech. Some of these companies that are public companies, meaning like they're publicly saying that they were customers of Silicon Valley Bank. Most of those run our lives, right? Like we need. I mean, really think about it. Like that's how we live these days. But I think in all aspects, it would have been a catastrophe. And it would have just, not that there isn't still fear in the banking industry, but it would have absolutely created even more fear, causing additional runs on more banks and at a much faster pace. And people just being terrified, not knowing where to put their money.
Yeah. So many of us in the PM industry have over $250,000, right? Because you have that's what FDIC insures, right? Up to $250,000. And so I've been hearing stories like people are like going to all these different banks, putting all these different money in different banks. For us, the 250 is typically in trust accounting, right? It's the security deposits. I know at Empire, I had close to $1 million in a trust account. So I know when I went to Chase and I was asking them to do a trust account, they just literally said, okay, this is in trust of, like, they just like relabeled the account. So what is the difference between like my Chase account that was really not a trust account evidently versus like a real true trust account? What is a true trust account?
So this is all called fiduciary accounting, right? So, and I'll say that first, the terms fiduciary, trustee, as agent for, and custodian are essentially just all used interchangeably, but the term, if you're reading about it with the FDIC, is fiduciary. Now, it's not that banks can't do it. Any bank can do it, meaning that, it's not like a product that you sign up for with the FDIC. I mean, of course, you have to be subscribed to the FDIC, but, for instance, you mentioned Chase. Chase, of course, is subscribed to the FDIC. So as long as you're subscribed to FDIC, which most banks out there are, you can get if you set it up correctly, your customers can get the same insurance. So I think that that's like the miscommunication or misunderstanding here in this industry. A lot of people think that it's just a product that we as enterprise offer. That's not it at all. It really comes down to our understanding and our knowledge of the requirements from the FDIC in order to get these accounts the protection that they need. So like, I hate to just call out banks, but you mentioned Chase, so let's talk about Chase. So a bank like Chase, for instance, might just set up an account as, Empire Property Management, which is the legal vesting of the name. And that is your legal vesting of the name. If you look at your articles of incorporation, that is the legal vesting. And then on the secondary line, which is just a nice word for nickname, in my opinion, but the secondary line could maybe, again, depending on which bank, I believe I see statements from all different banks all the time. Sometimes it doesn't even say this, but then it would just say trust on the secondary line. So that secondary line is essentially a nickname. There's nothing legal about that name added to the account. So it really comes down to the legal vesting of the entity itself at the bank on all depository records, not just bank statements, so that, for instance, if a receiver were to come in to the bank because your bank was under scrutiny or about to go under, they could come in and they could easily identify this account or this entity as a custodial held account, again, which is fiduciary trust account, for instance. But it has to be on all depository records in legal form. So for instance, like if you look at your legal name of business, it would read all of that information on there on the legal name of business, even though it's not your legal name of business, but it would read that within those depository records. That's like a very, very basic, I guess, part of it, but it really comes down to how the account is vested. So I'll go back to think about your family. I mean, most people out here, at some point they work with an estate attorney and get a trust created, right? I know my husband and we did a long time ago. Even though we're using, and most people do use yours or your spouse's social security number as the tax ID number for that entity, if that entity is created by an estate attorney, for instance, then that is essentially its own entity, even though it's under mine or my husband's social security number, because they have all the documentation to essentially say, okay, this basically your articles of incorporation for your trust, which they're not called articles of incorporation, but that's what you'd compare it to, show that that's the name of the legal name of this entity. So that's really what comes down to the most basic red flag, I would say. There is a lot that has to go into it, but that's probably the most basic red flag at the bank. So Chase and most banks out there, because that's not your legal name of business and that's not the legal entity name, they have to add it to the secondary line. So I think it really comes down to your bank, I guess specialty. I mean, enterprise as a whole is not a property management bank. We're a very, very well diversified bank, and we have specialty divisions in many markets, but we do have a specialty division in property management banking, right? So we work with legal, compliance, regulatory attorneys, our operations team. Everyone is on the same page about what these accounts are, how they have to be legally vested so that it's consistently, vested correctly as a chart of accounts at the bank.
Right. So in my case, if I had $1 million in security deposit account that was not set up correctly and something did happen, I would only be insured up to $250,000 of that $1 million. But if I set it up correctly, then it would show that that $1 million is actually made up of so many different accounts, and none of them are over the 250,000. Can you kind of explain that a little bit to the listeners?
Yeah. And bear with me, this might be long here. So again, it goes back to what I said about the bank setting the accounts up correctly, right? But so these fiduciary accounts, this is all called pass-through insurance as part of the fiduciary account. So you can have, we'll keep it more specific to property management, of course, but this is not related to only property management industry.
Got it.
But you can be acting as fiduciary or as trustee for multiple beneficiaries. That is really the term. The term is beneficiaries here, right? So whether that's your owners or your tenants, that's whose money you're holding on to. Beneficiary equals money people whose money you are acting as trustee for. So they are insured just like any other person or company at the bank, $250,000 across the board at the bank. So let's say, just as a disclosure, let's say, for instance, John Smith is in your, one of your owners, and he has $200,000 in your trust account. But let's say John Smith also has $100,000 just coincidentally at that bank because he opened a personal account with that bank, right? Which you might actually see in banks like the more consumer-friendly banks like Chase, Wells Fargo, Bank of America. That means John Smith is only insured $250,000 across the bank.
Oh, wow.
So, yeah. But again, you want to also make sure that he's even going to get his money out of the trust account, right? So to that point, certain disclosures have to be met. So you have to be as the agent. So just so you know, so in FDIC legal terms, the IDI is the bank, the agent is the trustee fiduciary, and then there's also a third party as well, which is typically like an escrow company, for instance, or an attorney. So the bank, of course, has to meet its requirements, of course, like we spoke about, which I mentioned one of them. And then the company or the fiduciary has to be holding name, tax ID number, as well as spot balances, essentially is what I'm calling it. So the ownership interest in that account, right? Or at that bank is probably a better way to think about it, because like I said, it's really across the bank. So you guys, the agents, do hold that information, right? So one of those three, the IDI, the agent, or the third party needs to be holding that information. You guys do hold that information. A lot of our clients know that we hold certain information as well, but you guys hold that information at all times within your software. So let's talk about, if you don't mind, like if Silicon Valley Bank had gone under, well, they did go under, but if they were not backstopped and if they banked a property management company, right?
You call it backstopped, I call it bailed out, tomato.
Yeah, it is backstopped. So let's just assume that trust accounts or property management companies, and let's assume, although I'm pretty accurate, it wasn't, but let's just assume that they did it correctly, right? So in a perfect world, they did it correctly, but the bank didn't backstop those deposits. So what would have happened, this is my verbiage, but I essentially call it like two different buckets, right? So there's the consumer company buckets, non-custodial held accounts, and then there's the custodial held accounts. And these are the two buckets for the purpose of this conversation. So we found out that Friday, when we found out that SVB was going under, we found out that, or they said that any insured depositor will receive their insured funds on Monday, right? So what that essentially means is that you pull it, it's all by tax ID number or social security number. So you pull that information, you as in the receiver pull that information, and it shows, okay, this company, basically all these companies or tax ID numbers or however you want to picture it, if they have more than 250,000, they were going to get 250,000 on Monday when they came in to get access to their funds. If they had less, of course, they just get whatever they had. Now there's the separate bucket, which I call the custodial held accounts. They need to first be able to identify that these are actually true custodial held accounts. Again, that goes back to the bank's liability, right? What the bank is doing to underwrite those accounts correctly at the bank. And if they can easily identify that, let's say that custodian comes in on Monday, and that custodian, let's call them, the property manager, comes in and shows that based off of their property management software report, which is normally what it is, that as of the day that the bank went under, so Friday, the day that the bank was seized, I should probably use seized instead of one that went under, but the day that the bank was seized, No one owner within that account had, or relationship, I should say, had more than $250,000. Now, you also have to show that not only did they not have more than $250,000 under your fiduciary held relationship, they also didn't have any more money at the bank. Now that goes to the receiver, right? So the receiver essentially sees your spot balance. Let's say your spot balance, like I said, was $200,000 for John Smith, based on that tax ID number. They also have to run that tax ID. I mean, I'm saying this in very layman's terms, but they also have to run that tax ID number to see that John Smith doesn't have any more than that at the bank under that social security number. So now would you get, because of all that work that they have to do, would you get your money back that day? No, it would take a few days, but it would be insured if it was all done correctly. And it would take a few days instead of either never getting the funds back or several months, maybe even years through the court system to get those funds back, right? Of course, and then there's a trickle down effect that your business would basically be out, right? So that's what I meant earlier. Like it would just be catastrophic if people couldn't get it trickles down to everyone. So it really comes down to how you are holding the information, as well as how the bank is setting these accounts up correctly. That's obviously what we do, but it is very difficult. Maybe not for me anymore, but it was to get into it, right? It's a very difficult chart of account to fully understand, and not only understand, invest correctly, but also more importantly, manage moving forward for banks. And you know, I could go down a rabbit hole about this, but it's not, and I won't, but it's not just about you and your compliance. It's about us and our compliance as well. We go through audits as well. We are held to certain standards as well. And so there is a lot more that needs to go into it, which is why, in my opinion, a true division is really what matters, because you don't just have one banker there saying, yes, absolutely, this is correct, but then that banker leaves tomorrow. What does that mean, right? You have an actual team with policies and procedures and understanding of how this all works.
That is an incredible amount of knowledge, Allison.
It's a lot.
It is a lot. And I think the main takeaway is make sure that, especially for us in the PM firm, the PM industry that has a lot of big accounts, that security deposit account, make sure it's set up correctly. And so that you're just making sure that your client's money's insured, basically. Would that be a good kind of like high level? Like first thing I should do is make sure my security deposit stuff is set up correctly, because that's our biggest exposure with something like this. Yeah.
Yeah, and I just need full disclosure. It's not just your security deposits either, right? It's your client trust funds. It's what a lot of people in this industry call their operating account. That's not what a bank would consider an operating account. That's what we'd consider a client trust. But basically, the rule of thumb to think about, which I've been telling everybody for years, is really just think anytime, even if it's for 5 minutes, anytime that you're holding funds that don't belong to you, that needs to be held in trust, because you're acting as fiduciary for those funds. Interesting.
Okay. So let me ask you this. What's your take on security deposit and the kind of the owner deposits? Like, do you combine them typically, or do you see most people combine the two, or do you see most people separate the two? I've seen it both. I've seen it done both ways, but just wanted to know where you came out on that.
Well, this is more of a state question too, right? Like some states, you actually do have to separate them. States like California, for instance, you don't need to separate them. They don't tell you one way or the other which one to do, but I know that it is preferred to combine them, right? So I actually think, again, I can't change the state's rulings. In some other states, most states require you to separate them. I can't change their rulings on that, but I actually completely disagree with it. So, you know, it's obviously accounting issues. Like if you think about, let's say that you are collecting, right? You have two separate accounts. You're collecting rent. You collect, a tenant pays a little late on the 4th. You pay out your owners by the 6th. You find out from your bank that, that tenant bounced their check. Now you've essentially robbed from Peter to pay Paul. And in a state like California, who's very strict on their audits, they're going to catch that. And that's obviously not only frowned down upon, but you could get fined for, or fail an audit for. So if you have that security deposit, that's covering the deficit in the interim. So yes, could you transfer the security deposit in? Sure, you could cover that deficit, but I just feel like why not yeah, it's just more work, just combine everything. And if you have the accounting software, which I'd say 99% of the companies out here do, then it's going to account for that anyway. You don't really need to separate them. It's not easier accounting by any means.
That's great. Well, thanks, Allison. All right, we are up against it. We're going to take a quick commercial break, and then I'm going to hit you with the lightning round.
Okay.
All right, we'll be right back, everybody. All right, welcome back, everybody. Allison DiSarro, you are now officially in the lightning round. Are you ready?
All right. I don't
Sounds like
know.
you're nervous.
I think
All right.
so.
I know as one who downloads the NARPM podcast all the time, you know who the lightning round. So I'm sure you got this.
Thanks, Pete.
What is one piece of advice you would give someone just starting out in business?
Tap your resources.
Say that again. Tap your resources.
Tap your resources.
Okay. Does pineapple belong on pizza?
I mean, well, it depends on who you're asking.
I'm asking you.
Todd O? I'm not sure. Yeah. No, actually, no. I will answer that for myself. Pineapple does not belong on pizza. Okay.
Well, we are in agreement there. What book are you currently reading, or one that has impacted your business or life?
I'm currently reading slowly, and I'm going to blank on the name of it, but it's by Naval Ravikant. Is that how you say it? Naval Ravikant. Oh my gosh.
Okay.
It's like right outside my office. I'll go grab it. The almanac.
No worries. What was your first job?
My first job was at a, what do you call them? Not a gift shop. It was in Cape Cod, and it was like a novelty store.
Novelty shop. Okay.
Like had CDs and, you know, all that. It's kind of like a Newberry Comics.
Okay. Which Marvel character do you most associate with, or what superhero do you most associate with? You want me to go the other way?
Oh my God.
You want me to go the other way? You want me to go with Disney character do you most associate with? You can answer either one of them.
Okay. Shoot. This is too fast. Is that cheesy? I don't even know. Let's just go with that.
Which, you say that again? You blanked out for a second.
Wonder Woman?
Wonder Woman.
Go with that.
I like it.
I'm sure that's what my husband would call me. So, you know, let's just go with that. We'll ask him.
Other than the NARPM podcast, do you have another podcast that you listen to or recommend?
I love Jordan Morella's podcast, the Profitable Property Manager podcast.
It's a good one. It's a good one. Do you prefer dogs or cats?
Dogs.
All right. Allison, if somebody listened to this podcast and they want to reach out to you and start asking questions about Enterprise Bank and how they can start working with y'all, what's the best way to contact you?
My email, which is adisarro@enterprisebank.com. You can also just go to our website. If you go to enterprisebank.com and you search for our property management division, there's a contact us form in there, and that actually goes straight to me.
And if you would like to join NARPM, if you've been listening and you're on the fence, you can give them a call at 800-782-3452 or go to NARPM, NARPM.org. And if you are looking for remote team members or want to talk more about how they can significantly impact your business and your life, give me a call at 832-656-3740 or email me at pete@vpmsolutions.com. Allison, thanks so much for being here today. Really appreciate you.
Thanks for having me. Thanks so much.